Okay, so we've survived chapters 1 through 3. Hold on a second. We've survived chapters 1 through 3, and now we are going to start with chapter 4. So, very early on in the class, I probably mentioned the whole idea of cash versus accrual accounting, and I might have shown you like some examples as to why you don't do cash accounting, why we do accrual accounting, and some of it has to do with the rules of accounting, like the revenue recognition principle and the expense recognition principles, and we're going to look at some of those things in this chapter. And then we're going to learn how to, what they call, true up the books. So adjusting entries will happen every month. And adjusting entries are the things that help to true up the books. They help to make the numbers correct as far as accrual accounting is concerned. So let me go to the next slide here. Okay, so the first part of the chapter, we are going to look at the revenue recognition principle. We're going to talk about what that is. The expense recognition principle, which is really the opposite of the revenue recognition principle. They go together. And they explain why we're doing all these accrual type things. We are then going to talk a little bit about what the difference is between cash and accrual, why, what the difference is and why it makes a difference in accounting. We're going to talk about the different types of adjusting entries. It's kind of monotonous. I mean, we kind of go through a whole list and we're like, if it's this, you do this. If it's this, you do this. And it's really kind of boring and kind of monotonous. And you just have to, again, we have to learn the rules and how we go about doing the entries. Okay. We will then look at preparing the adjusted trial balance, which is super easy. Does everyone remember how you did the trial balance the first time? It's exactly the same thing, except you do it after you do the adjusting entries. So remember in the beginning, I might have mentioned the idea that we have the transactions, we journalize the transactions, we post them to the T accounts, we balance the T accounts, we create a trial balance, and then we went into the financial statements, right? But then I said later on we're going to learn a new step. Well, this is the new step. So we create the trial balance. We then do the adjusting entries, which are all the accruals and deferrals. We then do the adjusted trial balance, which is basically the same trial balance, but it's after you do the adjustments. Then you do the actual financial statements, okay? And then the second part of the chapter, after we do the adjusted trial balance, is closing entries and how you close the books. And this is the only time we're going to look at closing entries. It will be on the exam. It will be in your homework. Closing entries. Now, there's something called a month-end close and a year-end close. So a month-end close is where you do the adjusting entries. A year-end close is where you close out your accounts. So I'm going to ask you to make sure that you really read over that portion on closing entries before we have that lecture portion, because it's going to be something totally different from anything we've done. So I want you to, it's not really hard. Again, it's a list of rules and how you go about doing the process, but I just want you to read it so that you're kind of exposed to it before we get into it. Okay, so we have a lot of different stuff to cover in this chapter. All right, so one of the first things that affects accruals and having to do these accrual entries or deferral entries are periods. We as humans break things down into periods that have been created, and this is the periodicity assumption. So in accounting, the common periods that you hear of are monthly, quarterly, and annually, which is yearly. So we're going to see problems that are kind of an array of those. They're going to be kind of popping in and out. So you might get one problem where we're dealing with, say, a loan and we're dealing with interest and it's for 1 month. And then the next problem might be a loan and we're dealing with interest and it's for a quarter, which is how many months? 3. So there's 3 months in a quarter. You might then get another problem that's dealing with a full year or an annual, which would be 12 months. So you have to, again, slow down, pace yourself, watch the information that you're getting in every single line item. You have to really look at like the instructions for the problem. You have to look at the line item. You have to make sure that you're doing the right calculations based on what they're looking for, okay? I mentioned this before, but I'll mention it again, that a calendar year is what we all normally know. It starts January 1 and it ends December 31. That's a standard calendar year. However, companies have what's called a fiscal year. Fiscal means financial, so financial year. A lot of companies run on the same calendar year and financial year, but some companies don't. Some companies have different fiscal years. So, for instance, in education, their fiscal years tend to start in August, because when does school start? August. So that's when you know how we have like the 18-19 year or the 17-18 year. It's, you know, the first part or the last part of one year, second part or first part of the next year. So you have to pay attention to that. Pay attention to the problems. If they're telling you the fiscal year started January 1, or the fiscal year started April 1, or it ended August 30th, you have to pay attention to that, because that's going to make a difference as far as when their year starts and how you figure things out, okay? So just make sure you're really watching for that. Okay, the revenue recognition principle says that in accounting, we recognize the revenue when we actually provide the service, or we haven't got to the sales chapter yet, but we give them the product. So that's when you actually recognize the revenue. It does not matter when you get paid. You may never get paid. That doesn't matter. All you're worried about is recognizing the revenue when you actually provide the service or you actually provide the product to the customer, okay? That is totally opposite from cash. The way a cash system works is that you don't put the money in your books until they actually hand you the cash, which is the wrong way to do it. So if you have a small company and you're doing a cash basis, you'll want to move yourself to an accrual basis. It's something that it will help you to just keep your books cleaner. It'll help when you get big enough to have an accountant do your taxes for you, because they'll be doing things such as depreciation and things like that, which you have to be on an accrual basis for that to work. Okay. All right.
So you said we recognize the revenue once the service is provided.
When we provide the service, we recognize the revenue, no matter when it's being paid. So that means if we provide lawn service to somebody and they are going to pay us later, and it's January 1, we recognize that revenue on January 1. No matter if they're going to pay us in 6 months, 12 months, 10 years, we recognize it on the day the service is provided. Now, if they pay us for a service that's going to be provided over 12 months, do we recognize it all on January 1st? No, we recognize it over the life of the service that's being provided. So that's where we have the prepaid or the unearned revenue part. That's going to come in this chapter, where we get a bunch of money up front and say it's for a full year. Then what we have to do is we have to take that money and we have to show a portion of it being earned every month over the whole time we're providing the service. And the reason why is because it links to the next one. Oh, wait, hold on. Before we get to the next one, we're going to talk about this one a little more. So here's an example. So assume that Conrad Dry Cleaner cleans clothing on June 30th for $30, but customers do not claim and pay for their clothes until the first week of July. So even though they haven't picked up their stuff, you have provided the service. You have paid for the chemicals, you've had the electricity, you've had the employees, you've had all the expenses. So the revenue recognition principle says that you do it when the service is provided, and the expense recognition principle is kind of the opposite of that. So you're linking the two together, and we'll look at expense recognition in a minute. So what you do when you actually provide the service is you debit accounts receivable because they haven't paid you yet, and you credit service revenue to recognize that you've earned the revenue, okay? Then when you're actually paid, you debit cash and you credit the accounts receivable. Show that they paid you. Okay.
So wouldn't it be the same thing for unearned service revenue?
No, so if it was unearned service revenue, that's a great question. So let's say that in this problem it said, assume that Conrad Dry Cleaners was paid $600 for cleaning that they would conduct over the next year. So pays or paid means it's cash, right? So we would have been paid cash, so we would debit cash, and we would credit unearned service revenue because it's going to be over the next year. Then we would have to figure out how much of that $600 were we earning every month. And then we would do an adjusting entry, which is what we're going to learn in this chapter, to recognize how much revenue we earn each month, and we would move it out of unearned revenue into service revenue every month.
I thought you were saying earlier that we add on the service revenue rather than taking. I'll just.
You'll see when it comes. I think. Okay. All right. So the other part is the expense recognition principle. So we want to match the expenses and the revenues together, because when you have an expense, right? Let me say it this way: when you have a revenue of $10 and you have an expense of $1, what do you end up with? What's on the financial statement? What's that number at the end called on the income statement? Net income, right? So if you have a revenue of $10, you have an expense of $1, your net income is $9. So you want your revenue to be in the same month as your expense, or in the same period as your expense, because they're connected together. So you don't want to have a revenue for say you're you're a tutor, right? You don't want to, you're a tutor and you do all kinds of academic work. You don't want to have a revenue for tutoring in the month of January, right? And you haven't done any tutoring. They're paying you in advance. You're going to do tutoring in February. You want those two to be together. Same thing in that you don't want to do tutoring in January and then not get paid till February and put the revenue in February. You want that revenue to be in the same month that you had the service that you provided, because there's expenses associated with it. Maybe as a tutor you had to pay for copies. Maybe you had to rent a room to provide tutoring. There could be other expenses that you had. So that's the thing, you always are going to want to link your expenses and your revenues together. Okay, that's the expense recognition and the revenue recognition. I'm not going to have a multiple choice question about that. You just need to know that, because that's the reason why we do a lot of what we're doing.
But so same thing as revenue just stated when you acquire it, when you not when.
Expenses?
Yeah.
Yeah, so expenses are when the expenses actually occur, not when you're going to pay it.
Okay.
So when it actually happens, when you actually have the expenses happen. Okay, so here's an example of an expense. So assume Conrad Dry Cleaners pays $5,000 in salaries in June for work that customers will not pay until July. What is the expense entry?
June.
The expense entry is actually in June, because it doesn't matter when the customer is going to pay you. If those people worked in June, that's when they have to be paid. That's when the expense occurred. So you would debit salaries and wage expense, and you would credit cash in the month of June. Even though the customers aren't paying you till July for that work, the revenue is in June. So the revenue and the expenses are staying together. So this is in your book. This is just a little kind of map that shows you these things connected together. And we do all this because it is part of GAAP, which is the generally accepted accounting principles. It's the reason why we do things this way. And it's so that everybody's kind of following the same rules. Remember how we talked about that before, that, you know, some of these rules seem kind of crazy, but it's to keep us, we're all doing the same thing. So even though it's crazy, we're all crazy together, right? I don't know. All right, let's go to the next slide. Okay, so this is just kind of giving us some ideas of how, when you don't do accruals, it messes up your books and it's not correct. And I've mentioned before the whole idea of cooking your books, and that's when you're moving numbers around to make them sound better. So here is kind of an example. So it was alleged, quote unquote, that Krispy Kreme sometimes doubled the number of donuts shipped to wholesale customers at the end of a quarter to boost quarterly results. The customers ship the unsold donuts back after the beginning of the next quarter for a refund. So if they ship $10,000 worth of donuts to their customer on June 30th that their customer really didn't want, those sales showed in their books, right? But then in July, the customers turned around and returned all those donuts. So they're really kind of getting themselves in a difficult situation, because they're setting themselves up for the next month in the hole, because they're already in the hole $10,000, right? Because now they're going to get this returned. So it's not a good practice to do. Another one here is Computer Associates International was accused of backdating sales. That is saying that a sale that occurred at the beginning of one quarter occurred at the end of a previous quarter in order to achieve the previous quarter's sales targets. So that would be like, you're looking at your reports and you see that, I'll kind of do this on the board here just to give you an idea. So let's say that it's the month of January, and we do our financial statements, and we see that our revenue is $5,000, and we had only one expense. We're going to pretend like we had only one expense, and we had an expense, and the expense was $6,000. So now we have a net loss of $1,000. We've lost $1,000, right? But we don't want to do that. So what some people do, which is totally incorrect, is they'll say, oh, you know what, we have a sale, because you don't actually close the books on the 30th. Let me kind of back up a little bit. So on January 30th, you don't say, okay, all the business stops, let's close the books for the month and we're going to do the financial statements. No, what happens is that the 30th hits, you don't post anything else to the January month starting February 1. So as things come in for February, you're posting things to February, but things for January are still coming in. So you might get a bill for PG&E for January that doesn't come in until until February 8th. It's for the month of January. So you're usually not closing a month until about the 15th of the next month. It takes you a couple of weeks to get everything in and get your adjusting entries done and all that kind of stuff before you actually close the books. So what happens is, let's say that this company said, oh man, you know, they did their preliminary report and it's February 10th and they're like, man, we're showing we have $1,000 loss in January. We don't want people to see that. But look, we have a sale on February 3rd for $1,000. Let's just post it. Let's just date that January 30th. So what they do is they go back and they take that February invoice and they move it to the month of January in their books, and they recognize the revenue in January. So now their revenue, we'll say it was $2,000. Now the revenue goes up to $7,000, and now they have a net income of $1,000. Oh wait, $1,000. Okay, does that make sense? You do not want to do that though, because now you go into the next month and you're really already in a hole of $1,000 because you've taken one of your sales for the month of February and you moved it to January. And you just can't legally do that either. You just can't say, oh yeah, this looks good, I think I'll move this money over here. If you could, then there would be no rules, right?
So what about, like, it wasn't legally wrong, but you knew you're gonna have a way better month the next month, and then like it made up for that last month, but you knew you're gonna do better the next month, or
you still can't do it.
Yeah.
And we don't know. What do we know? What do we really know? We don't know what's gonna happen, right? We really don't. Did everyone think that the housing market was gonna crash?
Mm-hmm.
Nope. I mean, you know what I mean? So it's like, you can think you're gonna have the best month ever and things could totally fall through. So you have to base it on the reality, and it has to be based on the current time in order to really be a true representation of what the accounting is. Okay. Go slides. All right, so when you do a cash basis, which is what most people do when they first start their own business, and initially it's not such a bad thing. You know, you're selling t-shirts out of your garage, or you have some kind of printing service or something like that. Initially it's not so bad, but if you understand how to do it the right way, you should do it the right way from the beginning. So with the cash basis, you only recognize revenue when you're paid, and you only recognize your expenses when you pay them out. It's the only time you recognize them on your books. You never want to do this in this class. You never want to do it in business from here forward, okay? And this is actually prohibited by GAAP. So by the generally accepted accounting principles, it is prohibited. So let's say you have a small company, you're renting it out of your house, it gets really, really popular, you start making a lot of money, you decide you want to go into something else and you want to sell your business. So if you go to sell your business and you've been running it on a cash basis, you're going to have a really hard time selling your business, because one thing people do when they buy a business is they bring an accountant in to look at the books. They should be bringing an accountant in to look at the books. And so that accountant, they're going to have to pay that accountant a lot of money to go back through your books and kind of figure out how things should have been done. So some people might not even be interested in it. So you want to make sure that you have it. Remember how we talked about in the very beginning, one of the rules is transparency. Another one of the rules is, following the same principles. So you want to make sure that you're doing it the correct way. Okay, so the reason why we have these accruals or these adjusting entries, that we do adjusting entries or we do what's called accrual accounting, is to make sure that these two things are always true. That revenues are recognized when the services are performed, even when cash is not paid, and that expenses are recognized when they're incurred, even if we haven't paid for them. That's why we do all these. So this next slide shows you, there we go, shows you kind of what I was showing you there on the board, but a little, bigger example. So suppose that Fresh Colors paints a large building in 2013. In 2013, it incurs and pays total expenses, which means salaries and paint costs, of $50,000. It bills the customer $80,000, but does not receive payment until 2014. So if they did it on a cash basis, in 2013, in 2013, they got no money, right? Nobody paid them anything. But they had $50,000 they had to pay out. So they're actually showing they had a net loss of $50,000 on a cash basis in 2013. Then when you go to 2014, it shows the revenue $80,000 because that's when they were paid, but they had no expenses because they paid in the previous month in cash. So now they're showing a net income of $80,000, which is really not true either. The true is this way. The revenue was actually earned in this month, even though it wasn't paid, or this year. The expenses actually occurred in this month or this year. And so the difference is $30,000. And then in 2014, there's nothing because those transactions don't relate to 2014. They have nothing to do with it. Okay? Do you have any questions about that? Does it make sense, or is it? Question?
So, the first one happens on the same year, right? That you did the service and.
This is the way we should be doing it, this top example. So they actually painted, they provided the service in 2013, so they earned the revenue, and they actually had the expenses in 2013. So this first example, the accrual basis under 2013 is the way the book should be done.
Okay, so I have a quick question. So if you're doing it based on the accrual basis, where you have your revenue and your expense, which your net income, despite not receiving that payment until the following year, how does that work with taxes?
Your taxes are based on your gross profit, and actually, it's based on the net after you figure everything. And when we get to the sales chapter, we'll look at that more, like taxes and stuff. But it's based on this. So, you're paying your net income based on when you actually earn the income, even if you haven't been paid or not. You have to pay taxes on that, even if you haven't been paid yet. But that's another reason why you don't want to recognize revenue ahead of the point. So let's say somebody paid you $50,000 for work that you haven't done yet, and you had no expenses around it, right? If you claimed it in 2013, let's say they paid us $80,000 and we didn't do the work. So we would have zero expenses. Then we would be paying taxes on $80,000 net income. See? So you want to make sure that you have them linked together all the time. But this is another reason why small businesses get themselves into problems, because they don't think about that kind of thing. Like this situation here, they'd have to pay $30,000 taxes on $30,000, right? There's other things that come into this number, but we'll just say it's net income that they're paying the taxes on. But if they haven't been paid yet and they have no money, no cash reserves, they're in trouble. Especially if this revenue, $80,000, is not going to be paid till after April 15th, and taxes are due on the 15th. So that's one of the biggest problems small businesses get into. They don't have enough money saved up in reserves to run their business. They actually, small businesses lose money the first 3 to 5 years, generally. So they really have to have a big chunk of money saved up to help with expenses. Okay, so adjusting entries happen every month. Some of the problems we do are going to be based on quarters or years. That's not real for the most part. Well, maybe quarterly on some things, but you're not going to wait until December 31st to do your adjusting entries for the entire year in the real world, because that means you've been false, your financial statements have been false for every month of the year because you knew there were things that had to be done that month that you didn't do. So we are going to get problems where you do them at the end of the year, but just know in the real world that doesn't really happen. It's done monthly. Some things are done quarterly. Most things are done monthly.
Nothing is done annually.
I can't think of anything you would wait till the end of the year, unless it was something that you only knew at the end of the year, like bad debt expense or something. When we get to that chapter, we'll look at that. So their adjusting entries are required every time a company prepares financial statements, and you should be preparing your financial statements every month. Okay. This is an important thing you want to know. This third bullet, very important. When you do an adjusting entry, it is going to include one account from the income statement and one account from the balance sheet, always. You're never going to do an adjusting entry that has 2 accounts from the income statement or 2 accounts from the balance sheet. It's just the way it's going to work out, all right? So does that relate to chapter 1? Yep, because you have to know which accounts go on which financial statements, right? Okay. And your adjusting entries never, ever, 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 ever include cash. You don't just randomly go in and say, yeah, I'm going to take $1,000 out of the cash account. No, because cash actually represents an asset that's a tangible asset, right? So you never do adjusting entries that have to do with cash.
1 second.
Mm-hmm. Okay. Okay, so here's a review question. Adjusting entries are made to ensure that A, expenses are recognized in the period in which they are incurred. B, revenues are recognized in the period in which the performance obligation is satisfied. C, balance sheet and income statement accounts have correct balances at the end of the accounting period. Or D, all of the above.
D.
All of the above. We do this for all of this, for all these things. Okay? All right. So I'm gonna stop the video real quick.